Okay, so what we're going to look at now is a budgeting question, in this case a cash budget. So let's have a look at the question first. So you've been presented with a cash budget, you've been presented with the following budget data for the period November 2011 to June 2012, the various departments in a business. Additional information is also made available to you. So we've got our sales are split between 40% cash and 60% credit, and those credit sales are received 2 months after the month of sale. Purchases are paid in the month following purchase. 75% of wages are paid in the current month and 25% in the following month. 75% of wages are paid in the current month and 25% in the following month. Overheads are paid in the month after they incurred. Dividends are paid 4 months after they're declared. Capital expenditure is paid 2 months after it is incurred. And we're told that the opening cash balance is expected to be 11,250 at the 1st of January 2012. So in the question, we're given our sales data, purchases, wages, overhead, capital expenditure from November until January. So let's take a look at the question. So what you remember from class would be that we break our budget down into 2 sections, our receipts and our payments. In this case, the only receipts that we have are our sales. We have no sale of assets, we have no other money coming into us, so we're just going to be looking at our sales. The 2 types of sales we're going to be looking at are, of course, our cash and our credit sales. So in this case, we have sales in January, because remember, we're looking for January to June. The November, December data is just data to help us. So when we look at our receipts here, we look at our cash sales from January. So in January, we had cash sales of 82,500. And we know that 40% of those sales are cash that we're going to receive now, and 60% are going to be sales that we receive in 2 months. So let's bring up our calculator. So cash sales for January were 82,500 multiplied by 40%. So our cash sales for January were 33,000. So now we need to find our credit sales. So we know that we receive our credit sales 2 months after the actual sale occurs. So our credit sales are coming from November. So we had 60,000 sales in November, and of that 60,000, 60% of those were credit sales. So let's go back to our calculator again. We had 60,000 in sales multiplied by 60%, which means that 36,000 of our sales in November were actually received in January. So 36,000 credit sales. Now let's go back to January again. In January we had 33,000 of cash sales. That also means that we had 82,500 by 60% credit sales. So we had 49,500 in credit sales, or that are attributable to credit sales from January. And they're paid 2 months after the month of sale. Which means that in January, 1 month on February, 2 months on March, we're going to have credit sales received of 49,500. And they're the total amount of sales that we received in January. 49,500 plus the 33,000 to give us our 82,500. So let's do the same for February. In February we had sales of 97,000. 97,500. Of those sales, 40% were cash, which means that our cash sales in February were 39,000. And our credit sales then are 2 months previous. So it's going to be from December. If we work backwards, our February back to January, and 2 months ago, we're taking credit sales of 60% out of the 75,000. So we want our 75,000 from December. We want 60% of that, which means that 45,000 credit sales is attributable to February from December. So before we go any further, let's look at February again. We had 39,000 in cash sales, so let's see how much we had in credit sales. Our 97,500 multiplied by our 60% give us credit sales of 58,500, and they're going to be paid 2 months after the month of sale. So in April, we're going to have credit sales received of 58,500. And we're going to keep doing that all the way along. In March, we're going to take 40% for cash sales. And our 40% of cash sales in March are going to be 42,000. So 40% of 105,000 is 42,000. And 49,500 we got from our January sales originally. Of that 105,000, 42,000 was cash sales, and 63,000 were credit sales, the 60%. In April, we had 40% of 112,500, which was 45,000, and we had credit sales of 67,500. So 60% of 112,500 up here. In May, we had cash sales of 120, or we had sales of 120,000, of which cash were 48,000, or 40% of 120,000. And 2 months on, well, 2 months on is out of our range. It's in July. We don't need it right now. So for June, we want our cash sales again. And our cash sales for June, 54,000. So 135,000, 40% of that were cash sales. And again, for June, our credit sales, well, we don't need them right now. We're only looking for January to June. So that's how we've calculated our receipts. And we can total these off then. Total them off: 69,000, 84,000, 91,500, 103,500, 111,000, 121,500. When we're finished with that, we're going to make our total column as well. Our total cash sales were 261,000. Our total credit sales, 319,500. So our overall total sales, 580,500. Okay, so next we need to look at our purchases. There are receipts done. And our purchases are paid in the month following the purchase. So we'll always pay our purchases in the month following when they were actually due. So in January, we're paying for our purchases in January from the month previous. So in December, we had purchases of 45,000. We're going to pay for those purchases in January, which means that our purchases in January are 45,000 coming from December. In February, our purchases are going to be 60,000. Again, our purchases from January are paid in February. In March, our purchases in March are what actually occurred in February. So our 67,500. And so on. Our April, so 82,500. From March, our May is our 97,500 for the previous month. And in June, 105,000 again from the previous month. And we'll total all of those up again. So our total purchases are 457,500. So they're just paid the following month after they occur. So next now we had our wages. So 75% of wages are paid in the current month and 25% the following month. So we've got to divide up our wages. What has to be paid this month and what has to be paid next month. So let's look at our wages here. For January, apologies. So for January, our wages were 12,000. So 75% of 12,000 will be paid in the current month and 25% will be paid in the following month. So, of our 12,000, excuse me, of our 12,000, 75% is paid this month. So 9,000 of our wages is paid this month, but we also have 25% from the previous month, because in December, 25% would have been paid to the following month. So we need to take 25% from December's total wages. And December's total wages were 9,000. So we need to take 25% of our 9,000 wages in December. So our 9,000 multiplied by 25% means that wages from December were 2,250, and they're the wages from the previous month. 2,250. Do the very same for February. So in February, our wage cost was 15,000. So 15,000. 75% of that is going to be paid this month. So 11,250 is going to be paid this month. And we also need to take 25% from the previous month. So 25% from the previous month, well, our 9,000 was the 75%, so 12,000 for the remaining 25% is our 3,000. So 3,000 from January is paid in February, and so on. So in March, our wage bill was 18,000. So 75% of 18,000 is our 13,500 paid this month, and we want 25% of the previous month. So we want 15,000, 25% of that, give us our 3,750. In April, our 75% wages were, in April, our wages were 21,000. So 15,750 is 75% for this month, and we want 25% from the previous month as well. So we want 18,000 by 25% to give us our 4,500. In May, our wages were 24,000, so 75% of our 24,000 is 18,000, and we want 25% from the previous month, which is our 21,000, by 25% to give us 5,250. And our final month in June, well, our wages in June were 27,000. So 75% of our 27,000 is 20,250. And we want 25% from the previous month. So our previous month's wages were 24,000. 25% of that, 6,000 dedicated to this month. And again, we'll total off both of those. So our total wages were 87,750 and our 24,750. That's our wages covered. So next we have to look at our overheads. Our overheads are paid in the month after they are incurred. So straightforward enough again. our overheads are paid the month after they're incurred. So in January, we're going to pay our overheads that we incurred the previous month. In the previous month, our overheads were 7,500. So we're going to pay our overheads of 7,500 from the previous month. In February, the same, 11,250 from January, 11,000 in March, our 11,250 that we incurred in February. In April, our 11,250 that we incurred in March. In May, our 15,000 that we incurred in April. And in June, our 15,000 that we incurred in May. So again, it's just the previous month into this month and so on. So in March, we pay February's incursion. Alright, in March, we paid the overheads that were incurred in February. In April, we pay the overheads that were incurred in March, and so on. So for our dividends, dividends are paid 4 months after they're declared. So let's look back at our question again. We declared dividends of 15,000 in December. So 4 months after, we're going to actually pay those dividends. So they were declared in December. So January, February, March, and April. So our dividends were declared in December, but we're going to pay them 4 months later in April. So 15,000 is going to be declared in April. We're actually going to pay that expense out. We incurred it in December, and we actually paid it 4 months later in April. So our dividends of 15,000. That's our only dividends expense. Lastly then, we have, well, for our payments, our last payment is our capital expenditure. So let's go back to our question. Our capital expenditure is paid 2 months after it is incurred. So our capital expenditure is paid 2 months after it's incurred. So we know we had capital expenditure of 22,500 in January, which means that 2 months later, we're actually going to pay that expenditure. So we have nothing in January, nothing in February, but in March, we're going to pay that 22,500. The 22,000 that was incurred 2 months before. We also had a capital expenditure in April. And because it feeds into our timeline, 2 months later is June, which means that we're actually going to incur another expense of 30,000 capital expenditure 2 months later in June. So our total capital expenditure in March and in June brings us to 52,500. And we'll total all these off again. So our total payments of 63,750. Okay, so now we have all of our totals. Totals for January and our overall totals for each of our different expenditures and receipts. So now what we want to do is we want to calculate, do we have more receipts or do we have more payments? Do we have more money coming in or more money going out? So we're going to take away our total payments from our total receipts and see, do we have more receipts or more payments? So our 69,000 minus our 63,750 leaves us with 5,250. It's a positive. In February, we had a negative minus 1,500, so 85,000 or 84,000 minus 85,500. In March, our 91,500 minus our 118,500 leaves us with a negative of 27,000. In April, we have a negative of 25,500. In May, we have a negative of 24,750. In June, we have a negative of 54,750, which gives us a total negative of 128,250. So, pretty negative across the board. These should all be minus figures. So, in most of these months, from February to June, we had more money going out than we actually had coming in. So now we need to actually balance up these accounts. We need to take, so what we're asked to do in the question, we need to balance up these accounts. So we're told that our opening cash balance is expected to be 11,250 on the 1st of January 2012. So our opening balance, we're being told, is 11,250. So if we have receipts of 5,000 and our opening balance from the previous month is 11,250, at the end of the year, we'd have a closing balance of 16,500. All of our receipts plus our opening balance. And if that's our closing balance for January, well, it must be our opening balance for February. So in February, our opening balance is 16,500, and we paid out 1,500 more than we actually took in, which means that our closing balance was 15,000, or 16,500 minus the 1,500, giving us an opening balance of 15,000. But 15,000 minus 27,000 is going to give us a negative balance, closing balance of 12,000. Carried over to the following month, our minus 25,000 minus 12,000 is going to give us another negative of minus 37,500. Just carry to the next month, so it becomes our opening balance of 37,500 minus 37,500 should be minus 12,000, and again minus 15,000. So a negative 24,750 minus 37,500 gives us a closing balance of minus 62,250, which brings us to our opening balance for June, 62,250 minus 54,750 to give us a final closing balance of 117,000 even. Our closing balance of 117,000 even. So let's look at our total column and see, does our total column match everything else that we've done? Because they should. So we know that our opening balance was 11,250. Apologies again, this should be a negative. So our total was 128,250. We had an opening balance of 11,250. So minus 128,250 plus 11,250 gives us a negative 117,000. So all of our months, when we balanced everything up, gave us 117,000. When we did the very same thing with our totals, we found out we were correct. It was negative 117,000. And that's how to prepare a cash budget. Thank you. Bye-bye.